When NVIDIA reports earnings, the entire AI market stops and listens. This time, the message was crystal clear. AI infrastructure demand is not just growing. It's exploding faster than anyone expected. And hidden inside that story is a much smaller ticker that suddenly became very interesting to serious AI investors. Nebius Group, symbol NBIS. In this video, we're going to break down how NVIDIA's latest earnings call completely changes the risk-reward profile for NBIS, why the market is suddenly taking this company seriously, and what the key numbers are that you need to watch before you decide whether NBIS belongs in your portfolio. Let's start with the big picture. NVIDIA told Wall Street that we're entering a $3 to $4 trillion AI infrastructure cycle by the end of this decade. That means trillions spent on data centers, GPUs, networking, cooling, power, and storage. Not over 20 years, but in the next 5 to 6. This is like rebuilding the world's digital backbone from scratch, except this time it's optimized for AI models instead of simple web traffic. If that forecast holds even approximately true, then companies that can deploy GPUs at scale, quickly and reliably, are going to see demand that looks less like normal growth and more like an infrastructure gold rush. Nebius wants to be one of those companies. So who or what is NBIS? Nebius Group is an AI infrastructure provider. Think of them as a specialized cloud company that focuses far less on Office apps and email and far more on one thing: delivering massive GPU power to customers who need to train and run advanced AI models. They operate data centers filled with NVIDIA GPUs, they connect those GPUs with high-speed networking, and they wrap everything in software so enterprises, startups, and even hyperscalers can rent that compute on demand. If you understand why CoreWeave suddenly exploded in relevance, you already understand the basic idea behind Nebius. But Nebius adds two twists: a deeper emphasis on sovereign AI regions, and a very tight alignment with NVIDIA's newest hardware roadmap. Unlike most cloud providers, Nebius isn't just a generic NVIDIA customer. NVIDIA actually holds an equity stake in the company, and Nebius is recognized as a reference platform NVIDIA cloud partner. That phrase sounds technical, but what it really means is this: Nebius builds its AI cloud using NVIDIA's own blueprints, with early access to next-generation chips like GB200 Grace Blackwell and Blackwell Ultra GPUs. From an investor perspective, that matters for two reasons. First, it gives Nebius a better chance of getting GPU supply when the market is tight. Second, it positions NBIS directly on NVIDIA's roadmap. When NVIDIA describes AI factories in its earnings call, Nebius is exactly the kind of partner they're talking about. Now let's talk numbers. In just a few quarters, Nebius has moved from relatively small revenue to what you could honestly call hyperscaler-style growth. In the first quarter, the company generated about $55 million in revenue, up roughly 380% year over year. By Q2, that number almost doubled again to just over $105 million. And in Q3, Nebius pushed revenue to roughly $146 million, growing more than 350% compared to the prior year. Those are not startup-level growth rates. Those are numbers that look more like a young hyperscaler catching a powerful wave of AI demand at exactly the right time. But the real story is not just quarter by quarter. It's the long-term run rate. Nebius annual recurring revenue, that's the contracted revenue expected over the next year, has climbed from around $249 million to about $551 million in barely half a year. Management is now talking about a $7 to $9 billion run rate by the end of 2026. Will they hit that exact number? No one knows. But the direction of travel is clear: larger contracts, longer commitments, and deeper integration into customer AI roadmaps. This is exactly what you want to see if you're betting on a long-term AI infrastructure platform. One of the biggest turning points for NBIS was the announcement of a massive contract with Microsoft. Over roughly 5 years, the deal is expected to be worth between $17.4 and $19.4 billion, as Nebius provides GPU capacity for Azure AI workloads. To support that, Nebius is building an entirely new data center in New Jersey, effectively dedicated to powering Microsoft's AI services. This is the same pattern we saw with CoreWeave, a focused GPU cloud company plugged directly into a hyperscaler's expansion plans. You don't get a contract of that size unless the hyperscaler trusts you to deliver. Shortly after Microsoft, Meta showed up. Nebius signed another multi-year deal worth around $3 billion over 5 years to deliver high-performance AI infrastructure for Meta's workloads. Now you have two of the biggest names in technology, Microsoft and Meta, committing billions to use Nebius as a core supplier. From a narrative standpoint, this moves NBIS from interesting story to verified part of the AI stack for multiple hyperscalers. Nebius is also leaning into another major trend, sovereign AI and regional cloud infrastructure. Today, the company operates around 7 AI clusters in 6 different countries, with a particular strength in Europe. That means governments, banks, healthcare systems, and large enterprises can access top-tier NVIDIA hardware without sending all their data to a single US-centric hyperscaler. This is a powerful selling point in a world where data residency, regulation, and digital sovereignty matter more every year. Now let's connect this back to NVIDIA's earnings. One of the biggest highlights was the ramp of GB200 Grace Blackwell and the Blackwell Ultra GPU family. These chips are designed for the next stage of AI. Huge foundation models, massive multi-tenant inference, and real-time generative workloads. Nebius is already deploying GB200 capacity in Europe and rolling out Blackwell Ultra clusters in the UK. That means when NVIDIA tells investors demand for Blackwell is off the charts, Nebius is one of the companies actually turning that demand into live, billable infrastructure. Of course, none of this is cheap. In the third quarter alone, Nebius spent close to $1 billion on capital expenditures, buying GPUs, building data centers, locking in power, cooling, and network capacity. From a traditional valuation lens, that looks scary. Big spending, big losses, lots of financial risk. But from an AI infrastructure perspective, this is what it looks like to build a new hyperscaler from the ground up. You spend heavily now to be ready when the AI demand wave fully hits in the second half of the decade. Right now, Nebius is not profitable. On a consolidated level, the company is still losing over $100 million per quarter. But here's the nuance. If you zoom in on the core infrastructure services, adjusted EBITDA margin has climbed to roughly 19% in Q3. In other words, the core AI engine is already approaching profitability, while the company continues to invest heavily around it. Management has said they expect overall EBITDA to turn positive sometime in the second half of 2025. Will that be exact? We'll see. But the direction is encouraging. Utilization is improving, and the core business is throwing off more cash. So how exactly do NVIDIA's earnings change the thesis for NBIS? First, when NVIDIA tells the market that demand for AI accelerators is stronger than expected, it effectively raises the ceiling for every company that rents out GPU capacity. Second, NVIDIA's commentary on AI factories, sovereign AI, and specialized cloud partners directly reinforces the Nebius model, regional AI clouds, built on NVIDIA references, serving hyperscalers and enterprises alike. Third, when NVIDIA confirms that Blackwell and GB200 are oversubscribed, it boosts the perceived value of any partner that already has early access and live deployments, and Nebius is on that list. Now, let's be clear, Nebius is not the only contender. CoreWeave is a major US player with its own huge Microsoft and OpenAI relationships. The big hyperscalers, Azure, AWS, Google Cloud, have enormous balance sheets and global footprints. Nebius fits in as a specialized, sovereign-friendly GPU cloud, tightly linked to NVIDIA's roadmap, with multi-billion-dollar contracts already signed. If AI infrastructure follows a multi-provider model, where workloads are split across several vendors for political, technical, and pricing reasons, Nebius could hold a durable seat at the table. But that does not mean NBIS is a safe bet. This is a high-risk, high-reward name. You have enormous CapEx commitments, ongoing net losses, and a real possibility of future equity raises that dilute existing shareholders. On top of that, the stock tends to trade at a premium to traditional software or infrastructure companies because investors are paying for the AI growth story years into the future. If demand slows, or if Nebius stumbles on execution, the downside could be severe. So how should an investor think about NBIS after NVIDIA's earnings? First, you're betting on growth, continuation of triple-digit revenue expansion, and a climb toward multi-billion-dollar run rate. Second, you're accepting balance sheet risk, high capex, and potential dilution in exchange for owning part of a fast-scaling AI cloud. Third, you're watching execution. Does Nebius deliver reliably for Microsoft, Meta, and other customers? And do they keep winning new deals? If those three pillars hold, then NBIS can be one of the purest public market plays on NVIDIA's AI infrastructure vision. To close, let's recap the key KPIs that matter most for NBIS. Explosive revenue growth from tens of millions to nearly 150 million per quarter. ARR accelerating from the mid-hundreds of millions toward the first billion, with management aiming even higher. Multi-billion-dollar contracts with Microsoft and Meta that anchor demand for years. A privileged relationship with NVIDIA, including equity ownership and early access to GB200 and Blackwell Ultra. Massive capex, nearly $1 billion in a single quarter to build out AI factories around the world. And finally, a clear, if bumpy, path toward EBITDA profitability as utilization increases. If you believe NVIDIA's earnings signal that the AI infrastructure wave is only getting started, then Nebius is one of the tickers directly in the blast radius of that growth. High risk, high volatility, but also, potentially, high reward. If you found this breakdown helpful, consider subscribing, dropping a like, and let me know in the comments. How are you positioning around AI infrastructure? Are you focused on NVIDIA, on the neocloud players like NBIS and CoreWeave, or on something entirely different? Thanks for watching, and I'll see you in the next one.